Hi everyone, in the previous video we were looking at an example where a bond was paying coupons on an annual basis. In this particular example we are going to look at a bond which pays semi-annually, which is typically an American bond. Now we have a 5-year bond with a face value of $1,000. It's sold on December 31st, 2021. The annual coupon rate is 6%, that is paying semi-annually. The price of the bond is $1,089.83. The yield to maturity is 4%, and we are going to start by recording the bond sale. So again, similarly, what we are going to have is our cash is going to increase, our bonds payable is going to increase by the same amount. Now let's calculate the cash outflows. As you see, there are going to be 2 cash outflows per year because it's paying on a semi-annual basis. The annual coupon rate is 6%. So cash outflow every 6 months is going to be the face value multiplied by the annual percentage, 6%, and I can make this like this, in parentheses, divide by 2. The 6% is paid on an annual basis, so every 6 months it's half of it is going to be paid. So every 6 months the company is going to pay $30, and at the end of the 5 year the company is going to pay the face value. Now the beginning book value is what we have here. There's nothing different about that. The interest expense is going to change a little bit in the sense that we will still have the beginning book value, but this time we are going to take yield to maturity and divide it by 2. So for the first 6 months the interest expense is going to be the book value multiplied by yield to maturity divided by 2. As you see, we are dividing both percentages, the yield to maturity as well as the coupon rate, by 2 when a bond is paying on a semi-annual basis. Our ending book value calculation is going to be pretty much the same. We are going to start with the beginning book value. Any payments is going to decrease your liability. Any accrued expense, interest expense, is going to increase your value, and as a result we are going to have $1,081.62 for that particular bond. The beginning book value of next year is going to be pretty much the same. That's what we are going to calculate, and I can drag this down. Again, the interest expense is going to be the beginning book value multiplied by 4% divided by 2. The ending book value is going to be beginning book value minus any cash payments plus any accrued interest expense. We can go ahead and have Excel do its work. As a result, as you're seeing at the end of the year 5, which is a 5-year bond, we are left with face value. We are going to pay that, and our ending book value is going to be 0, which is supposed to be. I'm going to stop here, and in the next video we are going to start looking at the questions themselves, and we are going to look at the journalized entries.